How central bank digital currencies, CBDCs, will transform finance. Central bank digital currencies, CBDCs, represent a groundbreaking evolution in the financial landscape, poised to transform how money is issued, managed, and transacted globally. As digital versions of a nation's fiat currency, CBDCs are issued and regulated by central banks, offering a secure, efficient, and innovative alternative to physical cash and traditional banking systems. The rise of CBDCs is driven by the rapid digitization of economies, the decline in cash usage, and the growing demand for faster, cheaper, and more inclusive financial services. By leveraging blockchain or other distributed ledger technologies, DLTs, CBDCs aim to enhance payment systems, improve monetary policy effectiveness, and address challenges posed by cryptocurrencies and private digital payment platforms. This transformative shift has the potential to redefine the financial ecosystem, impacting governments, financial institutions, businesses, and individuals alike. One of the most significant ways CBDCs will transform finance is by modernizing payment systems. Traditional payment infrastructures, particularly cross-border transactions, are often slow, costly, and inefficient due to intermediaries, legacy systems, and regulatory complexities. CBDCs can streamline these processes by enabling real-time, peer-to-peer transactions that bypass intermediaries, reducing transaction costs and settlement times. For instance, cross-border payments, which currently take days to settle, could be completed in seconds using CBDCs. This efficiency could boost international trade, remittances, and global economic integration. Moreover, CBDCs can enhance domestic payment systems by providing a secure and accessible digital alternative to cash, particularly in regions where banking infrastructure is underdeveloped. This could foster financial inclusion, enabling unbanked and underbanked populations to participate in the formal economy. Financial inclusion is another critical area where CBDCs can make a profound impact. According to the World Bank, approximately 1.4 billion adults worldwide remain unbanked, lacking access to basic financial services. CBDCs can bridge this gap by providing a digital currency that is accessible to anyone with a mobile phone or internet connection, even without a traditional bank account. Unlike private digital payment platforms, which may exclude certain populations due to fees, credit requirements, or technological barriers, CBDCs can be designed to be universally accessible and affordable. For example, central banks could issue CBDCs through digital wallets that do not require a bank account, allowing individuals to store, send, and receive money securely. This could empower marginalized communities, such as rural populations, women, and low-income households, to access financial services, build credit, and improve their economic prospects. CBDCs also have the potential to enhance the effectiveness of monetary policy. Central banks typically influence economic activity by adjusting interest rates and controlling the money supply. However, the transmission of monetary policy can be slow and uneven, particularly in economies with underdeveloped financial systems or high levels of informality. CBDCs can provide central banks with greater visibility into economic transactions, enabling more accurate and timely data collection. This could improve the precision of monetary policy decisions, allowing central banks to respond more effectively to economic shocks and inflationary pressures. Additionally, CBDCs could enable central banks to implement innovative policy tools, such as programmable money or targeted stimulus payments. For example, during a recession, a central bank could distribute CBDCs directly to households with expiration dates, encouraging immediate spending and stimulating economic activity. The introduction of CBDCs could also address the challenges posed by the rise of cryptocurrencies and private digital payment platforms. Cryptocurrencies like Bitcoin and Ethereum have gained popularity as decentralized alternatives to traditional currencies, offering benefits such as transparency, security, and borderless transactions. However, their volatility, lack of regulation, and potential for illicit use have raised concerns among governments and central banks. Similarly, private digital payment platforms, such as PayPal, Venmo, and Alipay, have revolutionized how people transact, but operate outside the purview of central banks, raising issues related to data privacy, financial stability, and monetary sovereignty. CBDCs can provide a regulated, stable, and sovereign digital currency that combines the benefits of cryptocurrencies and private platforms while mitigating their risks. By offering a trusted digital alternative, CBDCs can help central banks maintain control over monetary systems and ensure financial stability in an increasingly digital economy. Another transformative aspect of CBDCs is their potential to enhance transparency and reduce financial crime. Traditional cash transactions are anonymous, making them susceptible to illicit activities such as money laundering, tax evasion, and terrorist financing. CBDCs, on the other hand, can be designed with varying degrees of anonymity, balancing privacy with the need for transparency. For example, a CBDC could allow small transactions to remain private while requiring larger transactions to be traceable and subject to anti-money laundering (AML) and Know Your Customer (KYC) regulations. This could significantly reduce financial crime by making it easier for authorities to track and investigate suspicious activities. Additionally, the use of blockchain or DLT in CBDCs can provide an immutable record of transactions, further enhancing transparency and accountability. The adoption of CBDCs could also reshape the banking sector and its role in the financial system. Traditional banks act as intermediaries between central banks and the public, facilitating the distribution of money and providing financial services. However, the introduction of CBDCs could disrupt this model by enabling individuals and businesses to hold accounts directly with the central bank. This could reduce the reliance on commercial banks for basic financial services, potentially leading to disintermediation. To remain competitive, banks may need to innovate and offer value-added services, such as wealth management, investment advisory, and customized financial products. Alternatively, central banks could adopt a hybrid model, where CBDCs are distributed through commercial banks, preserving their role as intermediaries while leveraging the benefits of digital currency. Despite their potential, the implementation of CBDCs is not without challenges. One major concern is the impact on financial stability. If individuals and businesses shift their deposits from commercial banks to CBDCs, banks could face liquidity shortages, reducing their ability to lend and support economic growth. To mitigate this risk, central banks may need to impose limits on CBDC holdings or offer interest-bearing CBDCs to balance demand. Another challenge is ensuring cybersecurity and protecting against fraud, hacking, and other digital threats. CBDCs will require robust technological infrastructure and stringent security measures to safeguard user data and maintain public trust. Additionally, the design of CBDCs must address privacy concerns, ensuring that individuals' financial information is protected while complying with regulatory requirements. The global adoption of CBDCs also raises questions about interoperability and international cooperation. As more countries develop their own CBDCs, ensuring compatibility between different systems will be crucial for facilitating cross-border transactions and maintaining global financial stability. International organizations, such as the International Monetary Fund (IMF) and the Bank for International Settlements (BIS), are already working on frameworks and standards to promote interoperability and collaboration. For example, the BIS Innovation Hub has launched projects to explore multi-CBDC platforms that enable seamless cross-border payments. Such initiatives will be essential for realizing the full potential of CBDCs in a globalized economy. What do you think about CBDCs? Will they be a game changer or a financial risk? Drop your thoughts in the comments. Don't forget to like, subscribe, and hit the notification bell to stay updated on the latest trends in digital finance, blockchain, and the future of money. The role of oracles in smart contracts and decentralized finance. Oracles play a pivotal role in the functionality and expansion of smart contracts and decentralized finance (DeFi) ecosystems. Smart contracts, which are self-executing agreements with the terms directly written into code, operate on blockchain networks and are designed to automate processes without the need for intermediaries. However, smart contracts are inherently limited by their inability to access external data, as blockchains are closed systems. This is where oracles come in. They act as bridges between blockchain-based smart contracts and external data sources, enabling smart contracts to interact with real-world information. In the context of DeFi, oracles are indispensable for enabling complex financial applications, such as lending, borrowing, trading, and insurance, by providing accurate and timely data. Without oracles, the potential of smart contracts in DeFi would be severely constrained, as they would be unable to respond to real-world events or access critical information needed for decision-making. The primary function of oracles is to fetch, verify, and deliver external data to smart contracts. This data can include a wide range of information, such as market prices, weather conditions, sports scores, election results, or even IoT sensor readings. For example, in a DeFi lending platform, a smart contract may need to determine the value of collateralized assets in real time to ensure that loans remain adequately backed. An oracle can provide the necessary price feeds from external exchanges, enabling the smart contract to execute actions like liquidating collateral if its value falls below a certain threshold. Similarly, in decentralized insurance protocols, oracles can provide data on real-world events, such as flight delays or natural disasters, to trigger payouts automatically. By enabling smart contracts to interact with external data, oracles expand their utility and make them applicable to a broader range of use cases. Oracles are particularly critical in DeFi, where the accuracy and reliability of data are paramount. DeFi applications rely heavily on price feeds to function effectively, as they underpin activities such as trading, margin lending, and derivatives. For instance, decentralized exchanges, DEXs, use oracles to determine the prices of assets for trading pairs, while synthetic asset platforms use them to peg the value of digital tokens to real-world assets like gold or fiat currencies. Inaccurate or manipulated data can lead to significant financial losses, as seen in several high-profile DeFi exploits, where attackers exploited vulnerabilities in oracle systems to manipulate prices and drain funds. Therefore, the design and implementation of oracles are crucial to the security and stability of DeFi ecosystems. There are several types of oracles, each serving different purposes and use cases. The most common types include input oracles. These oracles fetch data from external sources and deliver it to smart contracts. For example, a price feed oracle that provides real-time cryptocurrency prices to a DeFi platform. Output oracles. These oracles enable smart contracts to send data or commands to external systems. For instance, a smart contract could use an output oracle to trigger a payment on a traditional banking network. Cross-chain oracles. These oracles facilitate communication between different blockchain networks, enabling interoperability. For example, a cross-chain oracle could allow a smart contract on Ethereum to access data from a blockchain like Binance Smart Chain. Compute-enabled oracles. These oracles not only provide data but also perform off-chain computations. This is useful for complex calculations that are too expensive or impractical to execute on-chain. Decentralized oracles. These oracles aggregate data from multiple sources to reduce the risk of manipulation or single points of failure. Decentralized oracle networks, such as Chainlink, use multiple nodes to fetch and verify data, ensuring greater reliability and security. Decentralized oracles are particularly important in DeFi, as they address the trust issues associated with centralized oracles. Centralized oracles rely on a single data source or provider, making them vulnerable to manipulation, downtime, or censorship. In contrast, decentralized oracle networks distribute the responsibility of data fetching and verification across multiple nodes, reducing the risk of malicious actors compromising the system. For example, Chainlink, one of the most widely used decentralized oracle networks, employs a network of independent node operators that retrieve data from various sources and use cryptographic proofs to ensure its accuracy. This decentralized approach enhances the security and resilience of DeFi applications, making them more robust against attacks and failures. The integration of oracles into smart contracts and DeFi platforms has unlocked a wide range of innovative use cases. One notable example is the emergence of decentralized prediction markets, where users can bet on the outcome of real-world events, such as elections or sports matches. Oracles provide the necessary data to resolve these bets accurately and transparently. Another example is parametric insurance, where payouts are automatically triggered based on predefined conditions, such as a hurricane reaching a specific wind speed. Oracles supply the data needed to verify these conditions, enabling seamless and trustless claims processing. Additionally, oracles are enabling the tokenization of real-world assets, such as real estate, art, and commodities, by providing the data required to peg digital tokens to their physical counterparts. Despite their critical role, oracles are not without challenges. One of the main issues is the oracle problem, which refers to the difficulty of ensuring that the data provided by oracles is accurate, timely, and tamper-proof. Since oracles act as intermediaries between on-chain and off-chain systems, they introduce a potential point of failure. If an oracle provides incorrect or manipulated data, it can lead to erroneous outcomes in smart contracts, resulting in financial losses or other unintended consequences. To mitigate this risk, developers are exploring various solutions, such as using multiple oracles to cross-verify data, implementing reputation systems for oracle providers, and leveraging cryptographic techniques to ensure data integrity. Another challenge is the scalability and cost of using oracles. Fetching and verifying external data can be computationally expensive, especially for decentralized oracle networks that rely on consensus mechanisms. This can lead to higher transaction fees and slower processing times, which may hinder the adoption of oracle-dependent applications. To address this, some projects are exploring Layer 2 solutions and off-chain computation to reduce the burden on the main blockchain. In conclusion, oracles are indispensable components of smart contracts and decentralized finance, enabling these technologies to interact with real-world data and unlock their full potential. By providing accurate, reliable, and tamper-proof data, oracles empower DeFi applications to offer innovative financial services, such as lending, trading, insurance, and asset tokenization. However, the design and implementation of oracles must address challenges related to security, scalability, and cost to ensure their long-term viability. As the DeFi ecosystem continues to evolve, oracles will play an increasingly important role in bridging the gap between blockchain-based systems and the real world, driving the next wave of innovation in finance and beyond. Oracles are the backbone of smart contracts and decentralized finance, DeFi, bridging the gap between blockchain and real-world data. As DeFi continues to grow, understanding the role of oracles is crucial for anyone interested in blockchain technology and financial innovation. What do you think about the future of oracles in DeFi? Will they enhance security or introduce new risks? Share your thoughts in the comments. Like, subscribe, and hit the notification bell to stay updated on the latest trends in blockchain, smart contracts, and decentralized finance. How DAOs, decentralized autonomous organizations, are changing wealth management. Decentralized autonomous organizations, DAOs, are revolutionizing the landscape of wealth management by introducing a new paradigm of governance, transparency, and inclusivity. DAOs are blockchain-based entities that operate through smart contracts, enabling decentralized decision-making and automated execution of financial activities without the need for traditional intermediaries. By leveraging the principles of decentralization, transparency, and community-driven governance, DAOs are transforming how wealth is managed, invested, and distributed. This shift is empowering individuals and communities to take control of their financial futures, democratizing access to wealth management services, and fostering innovation in the financial sector. One of the most significant ways DAOs are changing wealth management is by democratizing access to investment opportunities. Traditional wealth management services are often exclusive, catering primarily to high-net-worth individuals and institutional investors. These services typically require significant minimum investments and charge high fees, making them inaccessible to the average person. DAOs, on the other hand, lower these barriers to entry by allowing anyone with an internet connection and a digital wallet to participate. Through DAOs, individuals can pool their resources with others to invest in a wide range of assets, including cryptocurrencies, real estate, startups, and even art. This collective approach enables smaller investors to access opportunities that were previously out of reach, fostering greater financial inclusion and equity. DAOs also enhance transparency and trust in wealth management. Traditional financial institutions often operate as black boxes, with limited visibility into their decision-making processes and fee structures. This lack of transparency can lead to conflicts of interest, hidden fees, and mismanagement of funds. DAOs, by contrast, operate on public blockchains, where all transactions and decisions are recorded on an immutable ledger. This transparency ensures that all participants can see how funds are being managed, how decisions are being made, and how fees are being allocated. Smart contracts further enhance trust by automating the execution of financial activities, reducing the risk of human error or manipulation. As a result, DAOs provide a level of accountability and transparency that is unparalleled in traditional wealth management. Another transformative aspect of DAOs is their decentralized governance model. In traditional wealth management, decisions are typically made by a small group of executives or fund managers, with little input from the investors themselves. DAOs, however, empower their members to participate directly in decision-making through a voting mechanism. Each member's voting power is often proportional to their stake in the DAO, ensuring that those who have a greater financial interest have a greater say in the organization's direction. This democratic approach allows for more inclusive and community-driven decision-making, aligning the interests of the DAO with those of its members. For example, a DAO focused on real estate investments might allow its members to vote on which properties to acquire, how to manage them, and when to sell. This level of participation fosters a sense of ownership and engagement among members, leading to more informed and aligned investment decisions. DAOs are also driving innovation in wealth management by enabling new forms of financial products and services. For instance, decentralized investment funds, or crypto hedge funds, are emerging as a popular application of DAOs. These funds pool resources from members and invest in a diversified portfolio of cryptocurrencies and other digital assets. The use of smart contracts ensures that the fund's operations, such as asset allocation, rebalancing, and profit distribution, are automated and transparent. Another innovative application is the creation of decentralized index funds, which track the performance of a basket of assets and allow members to invest in a diversified portfolio with minimal fees. Additionally, DAOs are facilitating the rise of decentralized venture capital, where members collectively invest in early-stage startups and share in the potential returns. These innovative financial products are expanding the possibilities for wealth creation and management, offering new opportunities for investors to grow their wealth. The rise of DAOs is also challenging traditional wealth management firms to adapt and innovate. As DAOs gain traction, traditional firms are recognizing the need to embrace decentralization and blockchain technology to remain competitive. Some firms are exploring hybrid models, where they incorporate DAO-like features into their existing structures to enhance transparency and member participation. Others are partnering with DAOs or launching their own decentralized platforms to tap into the growing demand for decentralized financial services. This convergence of traditional and decentralized finance is driving a wave of innovation, leading to the development of more efficient, transparent, and inclusive wealth management solutions. Despite their potential, DAOs are not without challenges. One of the main issues is regulatory uncertainty. As DAOs operate in a relatively new and rapidly evolving space, they often fall into a gray area of regulation. This lack of clarity can create legal and compliance risks for DAOs and their members. For example, questions around taxation, securities laws, and liability are still being debated, and different jurisdictions may have varying approaches to regulating DAOs. To address these challenges, DAOs are increasingly engaging with regulators and policymakers to establish clear frameworks that support innovation while protecting investors. Another challenge is the technical complexity and security risks associated with DAOs. While smart contracts enable automation and transparency, they are also vulnerable to bugs, exploits, and attacks. High-profile incidents, such as the DAO hack in 2016, have highlighted the importance of robust security measures and thorough code audits. To mitigate these risks, DAOs are investing in advanced security protocols, multi-signature wallets, and insurance mechanisms to protect their funds and members. Additionally, the decentralized nature of DAOs can make decision-making slower and more complex, particularly as the organization grows. To address this, some DAOs are experimenting with new governance models, such as liquid democracy or delegated voting, to streamline decision-making while maintaining decentralization. In conclusion, DAOs are fundamentally changing the landscape of wealth management by democratizing access, enhancing transparency, and fostering innovation. By leveraging blockchain technology and decentralized governance, DAOs are empowering individuals and communities to take control of their financial futures and participate in new forms of wealth creation. While challenges related to regulation, security, and governance remain, the potential of DAOs to transform wealth management is undeniable. As the ecosystem continues to evolve, DAOs are poised to play an increasingly important role in shaping the future of finance, offering a more inclusive, transparent, and innovative approach to managing wealth. Decentralized autonomous organizations, DAOs, are revolutionizing wealth management by introducing transparent, community-driven decision-making in finance. As blockchain technology reshapes the investment landscape, DAOs offer a glimpse into the future of decentralized asset management. Do you think DAOs will replace traditional financial institutions, or are they just a trend? Share your thoughts in the comments. Like, subscribe, and hit the notification bell to stay updated on the latest innovations in blockchain, DeFi, and the future of finance. The future of identity management using blockchain technology. The future of identity management is being reshaped by blockchain technology, offering a transformative approach to how individuals and organizations manage, verify, and secure personal identities. Traditional identity management systems are often centralized, fragmented, and vulnerable to data breaches, identity theft, and inefficiencies. Blockchain, with its decentralized, immutable, and transparent nature, provides a robust foundation for creating more secure, efficient, and user-centric identity management solutions. By leveraging blockchain technology, the future of identity management promises to enhance privacy, reduce fraud, streamline verification processes, and empower individuals with greater control over their personal data. One of the most significant advantages of blockchain-based identity management is enhanced security and privacy. Traditional identity systems store personal information in centralized databases, which are attractive targets for hackers. High-profile data breaches have exposed millions of individuals to identity theft and fraud, highlighting the vulnerabilities of centralized systems. Blockchain, on the other hand, decentralizes data storage, distributing it across a network of nodes. This makes it significantly more difficult for attackers to compromise the system. Additionally, blockchain's cryptographic techniques ensure that data is securely encrypted and can only be accessed by authorized parties. For example, a blockchain-based identity system could use public-private key cryptography to allow individuals to prove their identity without revealing sensitive information. This approach, known as self-sovereign identity, SSI, empowers individuals to control who has access to their data and for what purpose, enhancing privacy and reducing the risk of misuse. Self-sovereign identity, SSI, is a cornerstone of blockchain-based identity management. SSI enables individuals to own and manage their digital identities without relying on centralized authorities. In an SSI system, personal data is stored in a digital wallet on the user's device, and identity verification is performed through decentralized identifiers, DIDs, and verifiable credentials. DIDs are unique, cryptographically secure identifiers that are registered on a blockchain, while verifiable credentials are digital attestations issued by trusted entities, such as governments or educational institutions. When a user needs to prove their identity, they can present a verifiable credential to a verifier, who can check its authenticity on the blockchain. This process eliminates the need for intermediaries, reduces the risk of data breaches, and gives individuals full control over their personal information. For example, a user could prove their age to a retailer without revealing their full date of birth or other sensitive details. Blockchain-based identity management also has the potential to streamline and simplify identity verification processes. In today's world, individuals often need to repeatedly provide the same information to different organizations, leading to inefficiencies and frustration. For instance, opening a bank account, applying for a loan, or signing up for a new service typically requires submitting identity documents, which are then manually verified by the organization. Blockchain can eliminate this redundancy by enabling reusable digital identities. Once an individual's identity is verified and recorded on the blockchain, they can share it with multiple organizations without needing to go through the verification process each time. This not only saves time and effort but also reduces the administrative burden on organizations. For example, a blockchain-based identity system could allow a user to verify their identity once with a government agency, and then use that verification to access services from multiple private and public sector entities. The use of blockchain in identity management also has significant implications for reducing fraud and enhancing trust. Identity fraud is a growing problem, costing individuals and organizations billions of dollars annually. Traditional identity systems are often susceptible to forgery and impersonation, as physical documents can be easily falsified. Blockchain's immutability ensures that once an identity record is created, it cannot be altered or tampered with. This makes it much more difficult for fraudsters to create fake identities or alter existing ones. Additionally, the transparency of blockchain allows for real-time verification of identity claims, reducing the risk of fraudulent activities. For example, a blockchain-based system could be used to verify the authenticity of academic credentials, ensuring that job applicants cannot falsify their qualifications. Similarly, it could be used to verify the identity of customers in financial transactions, reducing the risk of money laundering and other illicit activities. Another promising application of blockchain in identity management is in the realm of digital identity for the unbanked and underbanked populations. According to the World Bank, approximately 1.4 billion adults worldwide lack access to formal financial services, often due to the absence of verifiable identity documents. Blockchain-based identity systems can provide a solution by enabling individuals to create and manage digital identities without relying on traditional documentation. For example, a blockchain-based identity system could allow individuals to use biometric data, such as fingerprints or facial recognition, to create a digital identity that can be verified by trusted entities. This would enable unbanked individuals to access financial services, participate in the digital economy, and improve their economic prospects. Organizations like the ID 2020 Alliance are already working on blockchain-based digital identity solutions to address this challenge. The future of identity management using blockchain technology also extends to the Internet of Things, IoT. As the number of connected devices continues to grow, managing their identities and ensuring secure communication between them becomes increasingly complex. Blockchain can provide a decentralized and secure framework for managing IoT device identities, enabling secure authentication and data exchange. For example, a blockchain-based identity system could assign a unique digital identity to each IoT device, allowing it to securely communicate with other devices and systems. This would enhance the security and interoperability of IoT networks, enabling new applications in areas such as smart cities, healthcare, and supply chain management. Despite its potential, the adoption of blockchain-based identity management faces several challenges. One of the main issues is scalability. Blockchain networks, particularly public ones, can struggle to handle large volumes of transactions, which could be a bottleneck for identity management systems that need to process millions of verifications simultaneously. To address this, developers are exploring solutions such as Layer 2 protocols, sidechains, and hybrid blockchain models that combine the benefits of public and private blockchains. Another challenge is interoperability. For blockchain-based identity systems to be widely adopted, they need to be compatible with existing identity frameworks and standards. Efforts are underway to develop interoperable standards, such as the Decentralized Identity Foundation, DIF, and the World Wide Web Consortium, W3C, to ensure that different blockchain-based identity systems can work together seamlessly. Regulatory and legal considerations also play a crucial role in the future of blockchain-based identity management. Governments and regulatory bodies need to establish clear frameworks that support the use of blockchain for identity management, while ensuring compliance with data protection laws, such as the General Data Protection Regulation, GDPR, in the European Union. For example, GDPR's right to be forgotten poses a challenge for blockchain's immutability, as it requires that personal data be deletable upon request. To address this, developers are exploring techniques such as off-chain storage and zero-knowledge proofs to balance data immutability with regulatory requirements. Do you think blockchain-based identity management will become the global standard, or are there challenges that need to be addressed? Share your thoughts in the comments. Like, Subscribe, and hit the notification bell to stay updated on the latest trends in blockchain, cybersecurity, and digital identity. How tokenization is changing real estate investment. Tokenization is revolutionizing the real estate investment landscape by democratizing access, enhancing liquidity, and introducing unprecedented levels of transparency and efficiency. Real estate has traditionally been one of the most lucrative yet illiquid and inaccessible asset classes, often requiring significant capital, long holding periods, and complex transaction processes. Tokenization, which involves converting real estate assets into digital tokens on a blockchain, is breaking down these barriers and transforming how investors interact with property markets. By leveraging blockchain technology, tokenization enables fractional ownership, streamlines transactions, and opens up real estate investment to a broader audience. This shift is not only reshaping the real estate industry but also creating new opportunities for investors, developers, and property owners alike. One of the most transformative aspects of tokenization is its ability to democratize access to real estate investment. Traditionally, investing in real estate required substantial capital, making it inaccessible to many individuals. Tokenization allows properties to be divided into smaller, more affordable units, enabling fractional ownership. This fractional ownership model lowers the entry barrier, allowing retail investors to participate in real estate markets with relatively small amounts of capital. Additionally, tokenization opens up global investment opportunities, as investors can purchase tokens representing properties in different countries, without the need for local expertise or intermediaries. This democratization of access is fostering greater financial inclusion and enabling a more diverse range of investors to build wealth through real estate. Tokenization also addresses one of the most significant challenges in real estate investment: liquidity. Real estate is inherently illiquid, as buying and selling properties can take months or even years, and the process often involves high transaction costs and regulatory hurdles. Tokenization introduces liquidity by enabling real estate tokens to be traded on secondary markets, much like stocks or cryptocurrencies. Investors can buy and sell tokens representing fractional ownership in a property without needing to wait for the entire property to be sold. This liquidity not only makes real estate investment more attractive but also allows investors to diversify their portfolios more easily. For example, an investor can quickly sell tokens in one property and reinvest the proceeds into another, enabling more dynamic portfolio management. Platforms like Realty and Harbor are already facilitating the trading of tokenized real estate, creating a more fluid and accessible market. Transparency and efficiency are other key benefits of tokenization in real estate. Traditional real estate transactions are often opaque, involving multiple intermediaries, complex paperwork, and lengthy approval processes. Blockchain technology, which underpins tokenization, provides a transparent and immutable record of all transactions, reducing the risk of fraud and errors. Smart contracts, which are self-executing agreements with the terms directly written into code, automate many aspects of real estate transactions, such as property transfers, rental income distribution, and compliance with regulatory requirements. This automation reduces the need for intermediaries, lowers transaction costs, and speeds up processes. For example, a smart contract can automatically distribute rental income to token holders based on their ownership percentage, ensuring timely and accurate payments. This level of transparency and efficiency is enhancing trust and reducing friction in real estate markets. Tokenization is also enabling innovative financing models for real estate development. Traditionally, developers relied on bank loans, private equity, or crowdfunding to finance projects, often facing high costs and stringent conditions. Tokenization allows developers to raise capital by issuing tokens representing shares in a property or project. This approach not only broadens the pool of potential investors but also provides developers with more flexible and cost-effective financing options. For instance, a developer can tokenize a project at various stages, offering early investors higher returns in exchange for taking on more risk. This model aligns the interests of developers and investors, fostering collaboration and innovation in real estate development. Platforms like Red Swan and Brickmark are pioneering tokenized real estate financing, enabling developers to access global capital markets and investors to participate in high-potential projects. The impact of tokenization extends beyond individual properties to entire real estate portfolios. Real estate investment trusts, REITs, and other pooled investment vehicles can also benefit from tokenization by offering fractional ownership and enhanced liquidity. Tokenized REITs allow investors to buy and sell shares in a diversified portfolio of properties, providing exposure to a broader range of assets without the need for large capital outlays. This model combines the diversification benefits of traditional REITs with the liquidity and accessibility of tokenized assets, creating a more attractive investment proposition. Additionally, tokenized REITs can leverage blockchain's transparency and efficiency to streamline operations, reduce costs, and enhance investor trust. Despite its transformative potential, tokenization in real estate is not without challenges. Regulatory uncertainty is one of the main hurdles, as the legal framework for tokenized assets is still evolving. Different jurisdictions have varying approaches to regulating digital securities, and compliance with securities laws, anti-money laundering, AML, requirements, and tax regulations can be complex. To address these challenges, industry stakeholders are working with regulators to establish clear guidelines and standards for tokenized real estate. For example, the U.S. Securities and Exchange Commission, SEC, has been actively engaging with market participants to develop a regulatory framework that supports innovation while protecting investors. Another challenge is the technical complexity and security risks associated with blockchain technology. While blockchain provides a secure and transparent foundation for tokenization, it is not immune to vulnerabilities, such as smart contract bugs or hacking attacks. Ensuring the security and reliability of tokenized real estate platforms is crucial to gaining investor confidence. To mitigate these risks, developers are implementing robust security measures, conducting thorough code audits, and exploring insurance solutions to protect investors' assets. In conclusion, tokenization is fundamentally changing real estate investment by democratizing access, enhancing liquidity, and introducing transparency and efficiency. By enabling fractional ownership, streamlining transactions, and fostering innovative financing models, tokenization is opening up new opportunities for investors and developers alike. While challenges related to regulation and security remain, ongoing collaboration among industry stakeholders and regulators is paving the way for a more inclusive, liquid, and efficient real estate market. As tokenization continues to evolve, its impact on the real estate industry will be profound, reshaping how we invest in and interact with property in the digital age. Tokenization is transforming real estate investment by making property ownership more accessible, liquid, and efficient. With blockchain-powered fractional ownership, investors can now participate in the real estate market like never before. Do you think tokenization will become the future of real estate investment, or are there hurdles to overcome? Share your thoughts in the comments. Like, subscribe, and hit the notification bell to stay updated on the latest trends in blockchain, real estate, and digital finance. The role of blockchain in cross-border payments and financial inclusion. Blockchain technology is playing a transformative role in cross-border payments and financial inclusion, addressing long-standing challenges in the global financial system. Traditional cross-border payment systems are often slow, expensive, and inefficient, relying on a network of intermediaries such as correspondent banks, clearinghouses, and payment processors. These intermediaries add layers of complexity, increase transaction costs, and create delays, particularly for individuals and businesses in developing countries. Blockchain, with its decentralized, transparent, and secure nature, offers a revolutionary alternative that can streamline cross-border payments, reduce costs, and enhance financial inclusion. By leveraging blockchain technology, the global financial system is becoming more accessible, efficient, and equitable, empowering individuals and businesses to participate in the global economy. One of the most significant advantages of blockchain in cross-border payments is its ability to eliminate intermediaries. Traditional cross-border transactions typically involve multiple banks and financial institutions, each charging fees and adding processing time. For example, a payment from the United States to a recipient in Africa might pass through several correspondent banks, each taking a cut and delaying the transaction. Blockchain enables peer-to-peer, P2P, transactions, allowing funds to be transferred directly between parties without the need for intermediaries. This direct transfer mechanism reduces transaction costs and speeds up processing times, making cross-border payments more affordable and efficient. For instance, blockchain-based payment platforms like Ripple and Stellar are already facilitating real-time, low-cost cross-border transactions, benefiting businesses and individuals alike. Blockchain also enhances transparency and security in cross-border payments. Traditional payment systems often lack transparency, making it difficult for senders and recipients to track the status of transactions. Blockchain's immutable ledger provides a transparent and auditable record of all transactions, enabling real-time tracking and verification. This transparency reduces the risk of fraud and errors, enhancing trust in the payment process. Additionally, blockchain's cryptographic techniques ensure that transactions are secure and tamper-proof, protecting sensitive financial information from unauthorized access. For example, a blockchain-based payment system can use public-private key cryptography to authenticate transactions and ensure that only authorized parties can access the funds. This level of security is particularly important in cross-border payments, where the risk of fraud and cyber attacks is higher. Another critical role of blockchain in cross-border payments is its potential to enhance financial inclusion. According to the World Bank, approximately 1.4 billion adults worldwide remain unbanked, lacking access to basic financial services. Traditional banking systems often exclude these individuals due to high fees, lack of infrastructure, and stringent identification requirements. Blockchain-based payment systems can provide a more inclusive alternative by enabling individuals to access financial services without the need for a traditional bank account. For example, a blockchain-based mobile payment platform can allow users to send and receive funds using only a smartphone and an internet connection. This accessibility is particularly beneficial in developing countries, where mobile phone penetration is high, but banking infrastructure is limited. By providing a low-cost, accessible payment solution, blockchain is helping to bridge the gap between the banked and unbanked populations. Blockchain is also facilitating the rise of decentralized finance, DeFi, platforms, which are expanding access to financial services beyond traditional banking systems. DeFi platforms leverage blockchain technology to offer a wide range of financial services, including lending, borrowing, and trading, without the need for intermediaries. These platforms are particularly beneficial for individuals and businesses in developing countries, where access to credit and other financial services is often limited. For example, a small business owner in a developing country can use a DeFi platform to access a loan from a global pool of lenders, bypassing traditional banks and their stringent requirements. This democratization of financial services is fostering greater economic participation and empowerment, particularly for marginalized communities. The use of blockchain in cross-border payments is also driving innovation in remittance markets. Remittances, or money sent by migrant workers to their families in their home countries, are a critical source of income for many developing nations. However, traditional remittance services are often expensive, with high fees and unfavorable exchange rates. Blockchain-based remittance platforms are disrupting this market by offering lower fees, faster processing times, and more favorable exchange rates. For example, platforms like BitPesa and Abra are using blockchain to facilitate low-cost, real-time remittances, benefiting both senders and recipients. This innovation is particularly important in regions like sub-Saharan Africa, where remittances account for a significant portion of GDP. Despite its potential, the adoption of blockchain in cross-border payments faces several challenges. One of the main issues is regulatory uncertainty. Different jurisdictions have varying approaches to regulating blockchain and cryptocurrencies, creating a complex and fragmented regulatory landscape. For example, some countries have embraced blockchain and cryptocurrencies, while others have imposed strict regulations or outright bans. This lack of regulatory clarity can create compliance risks and hinder the adoption of blockchain-based payment solutions. To address these challenges, industry stakeholders are working with regulators to develop clear and consistent regulatory frameworks that support innovation while protecting consumers. Another challenge is the scalability of blockchain networks. While blockchain offers significant advantages in terms of security and transparency, it can struggle to handle large volumes of transactions, particularly in high-demand scenarios. For example, during periods of high transaction activity, blockchain networks like Bitcoin and Ethereum can experience congestion, leading to slower processing times and higher fees. To address this, developers are exploring solutions such as Layer 2 protocols, sidechains, and hybrid blockchain models that combine the benefits of public and private blockchains. These innovations aim to enhance the scalability and efficiency of blockchain networks, making them more suitable for cross-border payments. Interoperability is another critical factor for the widespread adoption of blockchain in cross-border payments. For blockchain-based payment systems to be effective, they need to be compatible with existing financial infrastructures and other blockchain networks. Efforts are underway to develop interoperable standards and protocols that enable seamless communication between different blockchain networks and traditional financial systems. For example, the Interledger Protocol, ILP, is an open protocol suite that enables payments across different ledgers and payment networks, facilitating interoperability and integration. In conclusion, blockchain technology is playing a pivotal role in transforming cross-border payments and enhancing financial inclusion. By eliminating intermediaries, enhancing transparency and security, and providing accessible financial services, blockchain is making cross-border payments more efficient, affordable, and inclusive. While challenges related to regulation, scalability, and interoperability remain, ongoing innovation and collaboration among industry stakeholders and regulators are paving the way for a more inclusive and efficient global financial system. As blockchain technology continues to evolve, its impact on cross-border payments and financial inclusion will be profound, reshaping how we transfer value and participate in the global economy. Blockchain is revolutionizing cross-border payments and driving financial inclusion by making transactions faster, cheaper, and more secure. As decentralized finance, DeFi, expands, millions of unbanked individuals worldwide could gain access to financial services like never before. Do you think blockchain-powered payments will replace traditional banking systems, or are there challenges that need to be addressed? Share your thoughts in the comments. Like, subscribe, and hit the notification bell to stay updated on the latest innovations in blockchain, digital finance, and global payments.